Life Healthcare has inked a deal to sell Life Molecular Imaging. Lantheus Radiopharmaceuticals UK will pick up the asset. The purchase consideration includes an upfront payment of an enterprise value of about 6.4 billion rand and potential earn-out payments of a further 7.4 billion rand, which will be linked to milestones of future sales of LMI products up to 2034. Life Healthcare plans to return the net proceeds from the upfront payment to shareholders within a year of the transaction being completed. Tharisa has reported lower production for the first quarter. That's as operations were affected by drilling equipment availability. Platinum Group Metals output fell 19% quarter-on-quarter, while chrome production slipped 12%. Commenting on the performance, CEO Fivos Parola stated that it was a tough start to the new year, but the group's focus would now be on optimizing the feed grade and improving its recoveries to previous levels, as drilling rates and equipment availability have improved. Jubilee Metals has failed to meet its copper production guidance for the 6 months to end December. That's mainly as a result of unplanned power outages which affected its Zambian operations towards the end of last year. The firm says it has put in place an additional power agreement with a new broad-based power provider, and that should help it return copper production rates to target levels. Schroder European Real Estate Investment Trust has seen growth in industrial valuations within its portfolio. As of the end of December, its industrial portfolio valuation increased 2.2%. That was driven by positive investment sentiment, translating into stronger investment volumes and yield compression. But office portfolio valuations declined 2.4%, with a reduction across assets in Paris, Hamburg and Stuttgart. Further afield, China's exports gained momentum in December, with imports also showing recovery. The strength at the year-end was in part fueled by factories rushing inventory overseas as the nation braced for heightened trade risks under a Trump presidency. Here's more detail in this package report.
China's exports accelerated last month, while imports also slowly recovered. It was in part driven by factories rushing inventory overseas as they ready for bigger trade risks under a Donald Trump presidency. Exports have been a vital growth engine for China, a bright spot for an economy still hurt by a prolonged property crisis and low consumer confidence. Customs data showed outbound shipments in December rose 10.7% year-on-year, well above analyst projections and November's reading. Imports surprised to the upside with 1% growth, the strongest performance since July last year. Economists had expected a decline. A Chinese customs spokesperson told Reuters there was still huge room for China's imports to grow this year. Analysts said a weakening yuan helped Chinese manufacturers find buyers overseas last year. China's exports grew by an annual 5.9% last year, while imports increased just 1.1% over the same period. Looking ahead, US President-elect Trump has proposed big tariffs on Chinese goods and raised fears of a renewed trade war between the two countries. Beijing also faces unresolved disputes with the EU over tariffs on Chinese electric vehicles. It threatens to hit China's ambitions to expand its autos exports and help address deflationary overcapacity concerns. Market reaction was muted to Monday's trade data. The yuan hovered near 16-month lows against the dollar, while key share indexes were down.
Sticking with China, Chinese and Indian refiners are scouring the globe for supplies of crude. This as fresh US sanctions on Russian producers and tankers curb shipments to Moscow's top customers. Here's more on this in this report.
Chinese and Indian refiners are scouring the globe for supplies of crude. It follows a move by the US last week to impose sanctions on Russian oil producers Gazprom Neft and Surgut Neft Gas, plus 183 vessels that have shipped Russian oil. The sanctions target revenues Moscow has used to fund its war with Ukraine. On Monday, China reiterated its opposition to unilateral US sanctions. Many of the tankers have been used to ship oil to India and China, as Western sanctions and a price cap shifted trade in Russian oil from Europe to Asia. Some tankers have also shipped oil from Iran, which is also under sanctions. Russian oil exports are expected to be hurt severely by the new sanctions, according to two Chinese trade sources. The expected disruption in Russian supply drove global oil prices to their highest in months on Monday. Among the newly sanctioned ships, 143 are oil tankers that handled more than 530 million barrels of Russian crude last year. One analyst told Reuters that's about 42% of the country's total seaborne crude exports. He added that of these, about 300 million barrels were shipped to China, while the bulk of the remainder went to India. The new sanctions could push China and India back into the compliant oil market to seek more supply from the Middle East, Africa and the Americas. Spot prices for Middle East, Africa and Brazilian grades have already risen in recent months on rising demand.